Have you seen the chaotic headlines screaming about a massive, inevitable 2026 market crash predicted by Goldman Sachs? Wall Street influencers and sensational news articles have been working overtime to convince you that your retirement accounts are about to be wiped out. But what if I told you that the biggest giant in the financial world did not actually predict a crash at all? What they really predicted is a hidden shift in the market requiring a completely new investing playbook for the next decade. If you are sitting in cash or blindly pouring money into the exact same few stocks as everyone else, you are playing a dangerous game. Welcome back to White Asset, your premier destination for mastering your money and cutting through the endless financial noise. Today, we are pulling back the curtain on the massive 100-plus page Outlook report recently released by Goldman Sachs. Over the past few weeks, this incredibly detailed document has been hijacked by clickbait creators trying to generate fear. We are going to look past the scary thumbnails and break down the raw, authentic data. By the end of this video, you will understand exactly what the brightest minds in finance expect for the United States economy, the stock market, and your personal wealth. We will explore the real risks hiding in plain sight and give you the steps needed to protect and grow your money. Let us start with the most glaring misconception right out of the gate. Goldman Sachs actually titled their sweeping report, U.S. Resilience. Let that sink in. You do not title a report about an impending economic apocalypse with a phrase highlighting the strength of the nation. Instead of projecting a catastrophic collapse, the report is essentially a highly researched testament to the incredible durability of the American economy. Despite everything thrown at it recently, from inflation spikes and global conflicts to interest rate chaos, the United States market has proven remarkably tough, and Goldman believes it will continue to be exactly that. Their actual official headline prediction for the S&P 500 in 2026 is a solid 7% positive return. That is not a market crash, nor is it a devastating economic recession. It is a healthy, slightly below average gain. How did a team of elite quantitative analysts arrive at this specific 7% figure? It comes down to a simple math equation involving fundamental business growth and overall market valuations. First, Goldman expects a robust 11% growth driven by corporate earnings and dividend yields. American businesses are continuing to rake in massive profits. Consumer spending remains stubbornly strong, and the ongoing rollout of artificial intelligence infrastructure is pushing billions of dollars through the economy. These fundamental drivers create real underlying value. However, the analysts then subtract 4% from that expected 11% growth. Why? Because stocks right now are notoriously expensive. Goldman expects what is known as valuation compression. Essentially, they believe that over 2026, the premium price tags attached to many popular stocks will slowly deflate and return to normal historical levels. Take the 11% business growth, subtract the 4% valuation adjustment, and you are left with a 7% expected return. It might not be the jaw-dropping 20% gains seen in recent bumper years, but a 7% compounding return is still incredibly powerful for long-term wealth building. Furthermore, Goldman explicitly quantifies the risk of an actual economic recession at just 25%. That means they see a 75% probability that the American economic engine keeps humming along. So, why is everyone on the internet so terrified? The anxiety largely stems from the current price of the market, specifically something called the CAPE ratio, or the cyclically adjusted price-to-earnings ratio. Historically, the average CAPE ratio for the stock market hovers around 17. Right now, it is sitting near 40. We are currently at more than double the long-term historical norm. In fact, in the entire 155-year recorded history of the stock market, there has only been one other time the CAPE ratio exceeded 40, which was during the infamous dot-com bubble. When people hear that comparison, they understandably panic. The dot-com crash wiped out trillions of dollars in wealth and took over a decade for investors to break even. However, Goldman Sachs strongly argues that directly comparing today's market to the year 2000 is a massive mistake. Back then, the biggest companies were often entirely unprofitable, valued on blind hope rather than actual dollars in the bank. Today, the landscape is entirely different. The largest companies dominating the market are absolute cash printing machines with flawless balance sheets, generating billions in free cash flow every quarter. On top of that, American companies have structurally increased their profit margins over the last 2 decades. We have shifted heavily toward asset-light technology businesses that do not need to build massive factories to generate revenue. Higher profit margins naturally justify higher stock valuations. Historical data clearly proves that expensive markets can remain expensive for years while still producing positive returns. High valuations act more like a subtle headwind rather than a sudden tripwire for a market crash. The road from being heavily overvalued to fairly valued does not require a violent crash. It can happen smoothly through years of modest sideways gains where earnings slowly catch up to stock prices. While a crash might not be imminent, Goldman does raise a massive red flag about something else entirely: market concentration. Right now, the top 10 stocks in the S&P 500 make up over 40% of the entire index. This is the highest level of market concentration in recorded financial history, eclipsing even the dot-com bubble. If you consider yourself a safe, diversified investor because you hold a standard S&P 500 index fund, you need to hear this. For every dollar you invest, 40 cents is funneled into just 10 mega corporations. Nvidia alone accounts for roughly 7% of the market, and the Magnificent Seven technology stocks command about a third of the index all by themselves. This creates extreme structural fragility. These tech giants are phenomenal businesses, but when an index is this top-heavy, its performance is no longer a true reflection of the broader economy. Instead, it becomes entirely dependent on the fortunes of a handful of companies. If artificial intelligence spending suddenly slows down, or if strict regulations hit big tech, the selling pressure could easily drag the entire market down, even if the other 490 companies are having a record-breaking year. Concentration heavily amplifies volatility. The market will swing much more violently in both directions than a truly diversified portfolio would. This is exactly why analysts at Goldman are quietly suggesting that equal weight index funds, where every company gets the exact same slice of the pie regardless of size, might actually outperform the standard top-heavy market over the next decade. Beyond stock market mechanics, the detailed Goldman report outlines 3 very real macroeconomic risks that everyone needs to monitor. First is the mounting United States government debt. Our national debt to GDP ratio is continuously climbing with no signs of slowing down. While the government has policy options like significant tax increases or sweeping spending cuts, analysts bluntly state they do not expect any political leaders to actually implement them. As the national debt swells, the government must issue more treasury bonds directly competing with corporate borrowing. Eventually, investors will demand higher yields to lend the government money, pushing interest rates up across the economy. It is not an overnight crisis, but a slow, persistent rot that could stunt long-term economic growth. The second massive risk is global supply chain dependency, specifically regarding China. The United States remains startlingly dependent on foreign adversaries. China currently controls nearly 70% of all rare earth mining, over 92% of rare earth refining, and practically all global magnet production. These are exact materials required for electronics, electric vehicles, and national defense. Any sudden trade war could immediately choke off materials America needs to function. The third risk is the chaotic state of monetary policy. Central banks around the globe are moving in completely different directions. While the Federal Reserve has started tweaking rates, the future path is murky. Investors have been aggressively trained for 15 years to believe the Fed will swoop in and cut rates to zero at the first sign of economic trouble. But what happens if inflation remains sticky? If prices are still rising during the next economic slowdown, the Federal Reserve might have its hands tied, leaving the stock market without its favorite safety net. Perhaps the most shocking number to come out of Goldman Sachs recently was not for 2026 at all, but their broader 10-year forecast. They made waves by predicting the S&P 500 might only average a 3% annual return over the next decade. This caused widespread panic, but the nuance is absolutely everything. That 3% forecast was strictly for the top-heavy standard S&P 500. Their global equity forecast was much higher, hovering near 8%. This brings us to the ultimate question. What should you actually do with your money based on all this exclusive Wall Street data? If you're a long-term investor with decades until retirement, the blueprint is remarkably boring but incredibly effective. You need to stay invested. Missing just the 10 best days in the market over a decade can slash total returns drastically, and those best days almost always happen right in the middle of terrifying market drops. Trying to time a crash is historically the best way to destroy your own wealth. The penalty for missing out on compounding growth is far worse than the temporary pain of riding out a normal market correction. However, if you plan to retire in the next 5 to 10 years, you cannot simply bury your head in the sand. You need to run new projections based on a realistic 6 to 7% return instead of the 13% average we have enjoyed recently. You might need to save a little more each month, delay retirement by a year, or adjust lifestyle expectations. Most importantly, look closely at your portfolio's concentration. If you are entirely reliant on the S&P 500, you are gambling on just 10 tech companies. Now is the perfect time to broaden your horizons, looking at equal weight funds and international markets. At the end of the day, fear is a product, and financial media is in the business of aggressively selling it. Sensational headlines generate millions of clicks, while measured, rational analysis gets completely ignored by mainstream algorithms. The brilliant minds at Goldman Sachs are genuinely cautious about high prices and heavy concentration, but their base case remains fundamentally optimistic about American resilience. They expect slower, steadier growth, not an apocalyptic collapse. Thank you for tuning in to White Asset. If you found this deep dive valuable, make sure to like this video, subscribe to the channel, and hit that notification bell so you never miss out on the financial truth. We are dedicated to giving you the unvarnished facts to help you build real generational wealth. Let me know in the comments below, are you changing your investment strategy based on these new predictions, or are you staying the course? Until next time, stay smart, stay invested, and keep building your assets.